The upcoming elections, analysts are predicting a rise in inflation in Kenya. That's as the shilling hits a new low of 88 to the dollar. It is trading slightly stronger than that level right now, but losing further ground against the major currencies on increased imports, falling investments and exports, making it, of course, difficult for the CBK to ease lending. Let's delve into this right now. We're joined by Paul Mwai, CEO at AIB Capital. Paul, thanks so much for joining us. So just talking to Kenneth Manjeri earlier, he was, of course, saying that the currency looks stable right now. They aren't seeing a depreciation to above 90 to the dollar. But, of course, inflation has started to tick up for the first time in 13 months. Firstly, where do you stand when it comes to inflation? Are you concerned around rising inflation right now?
I think it's not really a very big concern, but when our forecast for the inflation figures for February brings it to about 4.5%, it's still within the 5% margin or 5% target by central bank. But clearly we expect to see rising inflation. When we look at the factors, oil prices, we're also going into perhaps a rough patch in terms of the seasonal weather patterns, and therefore food prices are also likely to rise. When you put those together and also take account of the fact that, in previous months the base effect has been contributing to lower inflation, that has now rolled off. So going forward, we will expect no contribution from the base effect, slight increases in the overall inflation basket or inflation index, and therefore we expect inflation to be rising going forward, at least in the medium term.
Of course, the CBK has been embarking on accommodative monetary policy. It's been trying to get money into the system. We have seen that as a result of the fact that inflation has come down. But what does that mean for their efforts going forward? And firstly, I suppose before we get into that, how much money has in fact flowed into the economy? Are there any estimates with regards to that?
When we look at the last 4 months, the net effect of the maturities and take-ups of repos and term auction deposits, which is the open market operations by central bank, we are looking about 21.9 billion shillings being injected by open market operations into the economy. And perhaps that explains the increased liquidity in the market. Again, this is in line with the policy of lowering the CBR. So it has been on an expansionary monetary policy stance, so as to lower interest rates and stimulate the economy.
So, of course, there are push-pull factors for interest rates right now. But when it comes to government borrowing, looking to raise more money than that hadn't anticipated at the beginning of the year, raising that target by 31.6 billion shillings. What does that mean for interest rates right now? Is that going to exert upward pressure on rates?
Absolutely. On one hand, the monetary policy is putting downward pressure, but the requirement for government borrowing is putting upward pressure. I believe at least in the next few months, particularly until the election, where perhaps government expenditure needs are quite urgent, we will see interest rates ticking up or staying stable or slightly upwards. But perhaps after the election, we might see then the resumption to the decline in interest rates, or at least some stability in interest rates.
I mean, could this have a negative effect on growth in the country if you start to see interest rates tick up further? Because a lot of pressure on banks, for one, to decrease rates at this point in time, and they haven't decreased rates to a level that authorities are happy with yet.
Absolutely. I mean, we are hoping that the current tick up in interest rates because of the government borrowing requirement will be short term, because really we've just only gotten into an expansionary cycle, and to perhaps start moving interest rates back up again at this point would strangle the economy at a point when it's just perhaps getting above water. So we hope that the current situation is short term, and that the low interest rate environment would perhaps be a more longer term phenomenon.
Let's just talk about foreign investor sentiment, because if the government is needing to raise more money from the market, that is an important gauge to look at right now. And recently, the UK, France and Switzerland making statements that appear to caution against voting for Kenyatta. Of course, very controversial, sparking a lot of comments from government, sparking a lot of comments on social media. And the foreign minister basically saying this almost seemed like an orchestrated attempt to influence the vote during the election. What are your thoughts on that and the impact that might have sent, or the signal it might have sent to foreigners right now?
I think we haven't seen any reaction, interesting, from the foreign investors. If we look at just today's figures, we are still seeing 50.7%. If we take the stock market as a leading indicator, 50.7% of the trades today were from foreign investors, most of them on the buy side. So it looks like foreign investors haven't perhaps factored that factor in. So I think there's still a positive sentiment. It's still unclear. One, it's unclear who will win the election. It is also unclear what measures will be taken. And as a result, I think most investors are saying it's business as usual until perhaps we get a clearer view on what exactly the impact of that will be on the economy.